AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us today on the Real Estate Report. You can always call the show 800-516-1220, 800-516-1220, or you can visit us at bayarealoansource.com. You can always send us a comment or an email. This is a real estate show. We talk about all real estate, mortgages, purchases, investments, even property management, which, Gordon, you know a lot about. Gordon's been in the business 28 plus years, owned multiple properties, still has you don't like using the word flipped, but you do a lot of resales. And so you've got your fingers in pretty much every aspect of the industry. So you're an expert at that. I've been in financing for over 20 years. This is my niche. Here in the Bay Area, about, I want to say 17 years, all in the Bay Area, all in California. So you're working with some experts here that know the markets very well. Gordon, you've been through huge amounts of ups and downs and trends. It's got to be interesting to see what's happening right now. Have you ever seen a market where inventory is just ruling everything as far as comes to home prices?
You know, over the years, based on my experience, I've seen the market do a lot of different things. But this is the longest sustained bull market I've ever seen. I haven't seen market continue on an upward trend in such a long time without taking a breather. And it doesn't look like we're going to take a breather in the next year to 2 years, possibly. A lot of different things in the market. It's a phenomenal market if you're a real estate investor, if you're looking to get into the market, if you're thinking about getting into the market. If you haven't gotten in, there's still time to get in. A lot of different changes. As we talk on the show many times, of real estate, property, investments, the biggest expense you would ever incur in your life. And now is the time to do it because it will pay dividends.
One of the best liabilities you ever get your hands on, especially at the interest rates that are being offered. Interesting. There's even some people who don't fit the category of what they call a qualified mortgage or looking for lower interest rates. One of the things that the market has adopted over the several years out of what we call the Great Recession and Dodd-Frank and some of the qualified mortgage rules is a new market. We used to have something called subprime. Basically, loans that didn't quite meet the standards of your Fannie Mae, Freddie Mac, FHA, USDA, and VA. And they ended up going to what they call subprime. And there were so many different products. You had the NEGAM loans, you had teaser rates, you had stated income.
Interest only.
You had interest only. Much of that basically will never come back. We're never going to see a NEGAM loan again, in my opinion, even though forbearance is kind of like that right now, where they're adding you can skip a payment, it gets added to the end, or you can pay it off in payments. It's a little bit different, but we're not going to see a lot of those products come back. So one of the pieces of the market, and you always talk about how during these ups in these bull markets, we usually see products come out and drive the market. Right now, rates in combination with, decent guidelines, even though we're going to have to talk about this a little bit later, how getting a mortgage isn't as easy as it used to be over the last several years, going back to 2000. And we're basically on the scale, on what they call the Mortgage Bankers Association Mortgage Credit Access Index. We're back to 2014 standards today after having a great rise since then and then a big dip when we started COVID, which, by the way, this is the 1 year anniversary of COVID.
1 year anniversary, one bad year. We're all happy to see it go by. I think everybody's looking forward to another better year, I should say, rather than good. I think it looks like the vaccine is working. The numbers are down across the country. I believe some states are jumping the gun prematurely and getting rid of the mass directions altogether. Don't agree with that. I think in time it would work itself out, but every state has the capacity, the ability to do what they want to do, separated from the federal government. I think that's one of the big powers of our country, the rights of each state. California, we're probably still it looks like we're going to stay on the mass through at least probably the early summer. I think California is one state that looks like we're following the science. So if we follow the science, we'll probably stay true to where we are right now. But businesses are reopening. I think that's great for the economy, and that's great for our business.
Yeah, and again, going on back to products that are out there, I believe, this thing could have played out better. Everybody knows that. We had poor guidance early on. But one of the things that we did see is that the mortgage industry and the real estate industry did react very well. Everything from stimulus programs to the forbearance programs, and then Fannie Mae and Freddie Mac coming out with decent guidelines, the appraisal waivers we had, and then you have good rates. It's almost like the perfect storm for the people who can afford houses. But then going back to the products and how they drive the industry, one of the what is it? The right word I'm looking for? One of the
parameters. I don't know.
One of the parts of the loan industry that we're working with is called qualified mortgage. And then on the flip side, replacing subprime, is that fair to say? Replacing subprime is what they call the non-qualified mortgage arena. We have a guest here today, George Mears from ARC Home LLC. Am I saying that correctly? George is an expert in what they call non-QM, and it is one of the largest growing sectors in the market. At least it was pre-COVID. How did it fare when COVID hit?
Tony, thank you very much. Yes. It kind of retreated during that market just because it is a higher risk-based loan, but it's a non-qualified mortgage in the sense that it does not meet the Fannie Freddie requirements, the conventional type, where it's going to allow alternative credit, alternative income, the non-qualified mortgage. So it's definitely on the rebound since they've got a little more handle on the COVID, and we know what's going on in the market. So the non-QM market has rebounded, again, reintroducing the products for borrowers that don't meet the quote unquote, they don't fit in the box.
Near misses was what I've been explained it as.
Exactly.
And it's a very interesting sector, and it was growing
Absolutely.
very quickly pre-COVID, but it retreated immensely. It left a lot of investors wondering what to do.
Well,
and that is one of the products here that is able. It's called the DSCR loan.
Absolutely.
Which we'll get into some of these products that investors and other people use. We're using a couple that we just did today with ARC. In fact, those products are available for these investors and all likes of people. What is explain the use of these and why it's so important to have these near risk. I mean, not just the higher debt ratios you can use, but the lower credit scores, higher loan amounts with no mortgage insurance and things like that. Now you do sacrifice a little bit in rate, but
exactly
that is some of the trade-off. My philosophy has always been, or my saying is, the harder the loan, the lower the rate. The easier the loan or the guidelines, the higher the rate.
Exactly.
Explain a little bit about how that works.
It's all risk-based pricing, basically. So when you're outside the box, sure, there's a little bit of risk because there's the unknown. And going back to COVID, when everything happened, it's the 1-year anniversary. Everything was in turmoil, right? People didn't know what was going on, what was happening. Can people pay their mortgages? And so for the higher risk borrowers, these investors that were putting the money out there retreated because they really didn't know what was going on. Nobody knew what was going on. Everyone was glued to the TV. So now, fast forward a year, the market stabilized a little bit more. It's fast forward, values are high, rates are excellent, people are buying, refinancing. So now it's time for the outside the box lending to back and offer options. Basically.
Let's talk about some of the products so that we can really put some connections here to the people that are listening.
Yeah.
Non-QM have things like alternative income. You talked about it. What's an example of alternative income?
So alternative income may be a bank statement loan. So you have, self-employed borrowers that, have certain expenses maybe, and
their net is lower than their real actual. And they this, the stated income was that loan. Stated income was meant for self-employed borrowers, or that basically said, this is what I do, and they looked at a chart and said, okay, they put a zip code, and do you remember the chart? It had this little curve, and wherever you fit in it, that was the income they used. And the reason they did that is because you go to a W-2 or hourly employee, they use their gross income. Any W-2, they use their gross income. And self-employed, they use their net. So it's after expenses. So this bank statement product is what came out to replace that and give self-employed borrowers the opportunity to use their their actual gross cash flow.
And their average, exactly. So basically in calculating the income, you're looking at, what their expenses are versus what they're bringing in. So it's a truer form versus all, I hate to say it, the fluff of the tax return, right? Where there's, pluses and minuses. So here we're seeing a true number that's really giving the opportunity to the self-employed borrower to qualify and buy or refinance.
And you have lower credit score requirements for that as opposed to, and You're looking up to 1.5. If you go to a jumbo product and you want to go to 1.5 million, you need a 700 credit score in most cases. You need these large banks. You drive down the street, you see them, you need a 700 plus to get to 1.5. Yeah. You can go to 90% LTV. That's 10% down or 10% equity with a 660 credit score.
That's aggressive.
And you can only use 12. You only need 12 months of bank statements.
Yes.
Is that personal bank statements or is that business?
It's either. So if you have an individual that has a personal account and they also have a business account, or and they're transferring, they're paying themselves, you can qualify off the personal. If you have a business account, same thing. There's a calculation, but either or, there's no limitation.
Do you see any problems? I imagine you see many of these, since you guys are experts at non-QM loans, where somebody has a bank statement where their income's coming in, but they also put money over here as well, and they don't really account for it properly. What advice would you give somebody who has different sources of income that's going to different destinations, different bank accounts? Wouldn't it be simpler for these types of loans and the kind of schooling that you would want to give the people out there that would use these? Simply just make it easier on the lenders. And Absolutely. That's really what we're looking for. Yeah. Everyone goes, it's so hard to get a loan, but sometimes it is you. Right. It is you not doing it correctly.
Right. And unfortunately nowadays and forever, there is no really training or schooling on how to tell these business owners how to manage their business, how to do their financials. Yeah, it's definitely, the role of the originator or the broker to guide them, to show them, what to do and how to do better at it. But yeah, definitely put it in one source because it's easier to track and calculate, for everyone's, standpoint.
Yeah, that's something I always educate our borrowers on, that when you're looking for these type of programs, I think if you minimize and make your programs as easy as possible, even if you have multiple sources of income, you want to move it from different locations, bring it to one location. That's a lot easier to track when it comes time to using one of these programs that we're talking about.
And that's not just for non-QM or stated bank statement products. That's for almost any time you're moving money around. Yeah. Make it a lot simpler. We've seen people put pensions in one, Social Security in another, and then they got their payroll over here, and then they're moving money in between these accounts.
And then we have to explain the deposits.
Yeah, it's crazy. We'll come back after this break. Again, we have George Ramirez. He's a non-QM expert. That's kind of your subprime market. It used to be from ARC Home LLC. We'll come back after this break. You're welcome to call the show 800-516-1220, or you can email us, Tony or Gordon at BayAreaLoanSource.com. We'll be right back.
Questions about real estate? Call the program, 800-516-1220. Now, back to the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Let's check out our new website, Bay Area. Well, it's the same BayAreaLoanSource.com, but it's just a little bit different. We added a couple features to it and some things to do. BayAreaLoanSource.com. It's just a website. So it's something you can get in touch with us and send us an email. This is also a call-in show, 800-516-1220, 800-516-1220. We have George Ramirez from ARC Home LLC. Got to say that properly. We're talking about non-qualified mortgages and how they really fit into the market. Briefly get into a couple pieces of news. And, I don't know if it's news. It's just, these are reports. I like reports like this. We were talking earlier about the real estate market and, the ups and downs at Gordon that you've seen over many years and how this is unique. But we're looking at, are you ready for this? 200,000 fewer homes are listed in the same first 2 months of 2021 compared to the last year. That is 50% lower, and home prices are 10% year over year in that same period higher. That's just incredible to see that just that few of inventory is out. And now there were some weather issues, and it's also not the most attractive time of the year to sell a house, but there's still real numbers.
Yeah, well, you got to factor in COVID. A lot of people were nervous during COVID. A lot of people were undecisive. People weren't sure where we were going to be. I think now we're seeing the market kind of change and kind of made the adjustment. So I think we're going to have a great economy in the next 12 to 18 months. One of the things that we talked about with the non-QM, when people think non-QM, they think, oh man, high rate, subprime. But there's a file that I want to talk about. There's a person was buying a house, and we've been in contract to buy many homes, but the deal kept falling through. Finally came up with a property in Benicia. Unfortunately, Benicia is not in Alameda Country Club County, so the loan limits in those counties are a lot lower. We can actually use one of Georgia's non-QM products for that same client, even though she's a standard 8% A paper client. But because of the loan limit, she would have to put down a whole lot more money in order to qualify for that home. So these are all the flexibility that we always talk about. We always talk about it's great to have low rates, but programs is actually what rifles our market. The more programs we have, I think the more transactions we can close, the more people we can help get into actual properties. George?
So I truly feel like the non-QM business and the non-QM loan is an ability for a client or a borrower to get into a home. And sometimes, and most of the time it's temporary. I like to call it like a Band-Aid loan in some cases, where it could be that, you know, they have an instance in credit that's going to mature and therefore they can meet the QM guideline. So in a lot of
So
cases,
the QM loans, the Fannie Mae, Freddie Mac's, even maybe FHA are the what we call exit strategies, and these
Correct.
are the temporary. Let's just get it in. We work on a kind of short-term, long-term
Exactly.
strategy to fix whatever it was, whether it's your credit, maybe it's your income, maybe it's the way you report your taxes. It could be just a short-term financial situation. Fix that. Let's get that and then get into the better product.
Exactly. And it's really just how, you either you're self-employed, you're whatever your situation is, it's just how you handle your own business. And so, yeah, if you're self-employed and your goal is to file a different way in the following year, then you're going to be able to exit the non-QM loan and get into a qualified mortgage. So a lot of times, yeah, it's a short term. You come across a home that your spouse or yourself love and you need to have, but you're not in the right position to get. Here you go. This is an option for you. It's all about options. Now let's not think that the non-QM loan is a subprime loan. It's not a subprime loan. The difference is that in today's market and since the decline, there's something called ability to repay. And so every loan on the non-QM side, meets that requirement. The ability
You still have to
repay.
meet that
Yes.
requirement, even
That's
though
important.
you don't have to follow some of the stricter guidelines with debt ratio. You can go up to 50% in some cases
Yes.
with the right credit score and the right equity. These are still what they call risk-based products. So you still have to have a good credit score. But we were just talking off the air about there's two clients that we're doing right now. The interest rate is 1% difference, but only because the credit score was different. Everything else was the same. The loan amount, the down payment amount, the type of house, it was both a purchase, but it's a 1% difference. So these are heavily weighted towards credit scores, just like your Fannie Mae, Freddie Mac, FHA.
Exactly.
But they still have advantages in the sense where, well, okay, I'm going to get this loan. It's, with a 660 credit score, for example. And I know that eventually I'm going to get it over 700 based on the analysis that, your loan agent can do.
Absolutely. And me personally, at the end of the day, it really comes down to the mortgage payment. Can you afford the payment? Because, to me, the interest rate is relevant. You're filing your taxes, you're writing off more interest. So to me, it just comes down to the payment. And so if you can qualify for it and you love the home that you want to buy, go for it.
One of the interesting products that I've found in the market many years ago was Fannie Mae's asset utilization. They call it asset depletion or asset distribution. You don't actually use your assets, but what they do is they qualify a certain amount of assets. It could be $50,000 or it could be $5 million. And what they do is they basically take your qualified assets and they divide it by the term of the loan and it creates an income. So if you have $360,000 divided by 360 months, which is 30 years, you end up with $1,000 in extra month. And you can actually use that with your other income. It could be Social Security income, pension income, plus your asset depletion. And then there are some lenders that will actually, but what we found, it's not actually really as aggressive as some of these other non-qualified mortgage products that you guys offer. There's one product in particular that's called a 36-month asset utilization qualification. You're dividing that number, let's say 360,000, you're dividing it by 36 months instead of 360 months. So that instead of $1,000 a month in income, you're looking at $10,000 a month in income, and that helps your debt ratio immensely. You're looking at what is that, 1,000% more?
Yeah, it's a huge difference. I mean, we're looking at the asset, and of course, there needs to be terms that it can be withdrawn if need be, but it's an available asset, and so it's the client's money, and we're using it to qualify.
Yeah, you're basically saying, if something goes wrong with their other income, there's the asset that will pay for it. Now, of course, you need the credit score and you need the equity, and just like every loan out there, but it works in a situation where you again, I think the asset depletion or the asset utilization is a little bit more permanent in some cases because not a lot's going to change on that borrower's end as far as income unless it's just a transitional type.
Sure, and that's the big word, the transitional type. Let's just say you have a Silicon Valley, tech person. They're in one of the big arenas. They have, huge stock option, and now all of a sudden they break away and they want to open their own business. Well, on a qualified mortgage, you have to have 2 years of self-employment. Well, guess what? 2-3 months into it, they're not qualifying for a home. Here you go. Now you have, $3 million in stock.
You can use this product and then wait for the 2-year employment, and then all of a sudden you have a standard qualified mortgage.
Exactly.
That's a fantastic. I didn't even think of that. You don't need 2 yeyears of employment to use asset utilization.
You don't
product. How long do you have to season that money though?
You don't have any employment. There's no employment listed.
How long do you have to season the money?
4 months.
4 months seasoning. So you need to have that money needs to be yours for 4 months.
Exactly.
Some of these products are amazing when you really dive into it and how it fits into the market. Gordon, I know you're a big proponent of products being used in the market and how it drives the market. We're going to get back into a little bit more of this when we come back after the break. Again, we have George Ramirez from ARC Home LLC. You're also welcome to call the show, 800-516-1220, 800-516-1220, or shoot us an email, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. We'll be back on KDOW after this break.
Phone lines are open on the Real Estate Report. 800-516-1220. That's 800-516-1220.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You're always welcome to call the show, 800-516-1220, 800-516-1220, or email the show, Tony or Gordon at BayAreaLoanSource.com. We are in our 11th year on air, going on 12th.
And today's March 11th. How about that?
Perfect. St. Patty's Day is coming up. And a whole bunch of really interesting things. My brother just got COVID, which is amazing. Him and his wife just got COVID. And I'm not sure how to feel about that. He's on the East Coast, so I don't have any direct exposure with it. But this has been just an odd year. He won't be able to see my parents, which moved out there. They haven't been able to leave their facility for 12 months now. 12 months now, without an escort. And if they meet someone, they have to be quarantined for 2 weeks. So they're not going anywhere. And now my brother, and he's quarantined from his wife and his kids. He has 4 kids. It's crazy. I mean, how do you manage a house with 4 kids and you can't kind of interact with them?
Party time.
Party time.
if I was his son. Well, I mean, these things happen. I think most of the time we don't know how we get it. It's been a very mysterious disease, and it affects different people in different ways. But it looks like if he doesn't have any health issues, he should fine. It should be okay. Just a matter of being quarantined and following the rules, and I think he should come out of it just fine.
Yeah, we're all optimistic about that. Going back a little bit of real estate news, home buyers are losing a little bit of spending power as mortgage rates rose just a little bit. There's a little survey they did that the national average person, because interest rates went up, they're saying about 0.5 point. It's really less than that. Lose about $23,000 in spending power. This is a direct correlation to affordability, Gordon. We were already pre-COVID pushing affordability limits, and now we saw interest rates go down, but home prices exceeded expectations all across the United States, including affordable areas across the United States. And now we're running into slightly higher interest rates. What is your thought on?
Well, I'd like to mention some good news. When COVID first happened, when the
rates were higher,
when the market took effect, a lot of companies, a lot of investors actually upped the ante as far as the rules are concerned, especially on credit score and credit score qualifications. A lot of them add additional qualifications on just because of COVID. We weren't sure which direction was going to go. Now we're seeing, as COVID seems to be coming, I'm using this cautiously, under control. Now we're seeing some of these companies relax some of these pre-COVID rules, such as credit scores. We're seeing FHA credit scores back down to 580, where it was 640 before. So these are all the good things that happen as the market changes. And I think these are what it's going to make the market even roll even more, because now when you drop that score, we're bringing another round of borrowers into the equation that we couldn't have done 6 months ago simply because of the score requirement they couldn't meet.
Here in the Bay Area, we continually get the questions about how, let's say inventory starts feeding itself back into the market. Sellers are figuring out where they're going to go. we have baby boomers and other entities that are getting ready to sell. How that's going to play out into the market. We have George Ramirez from Arc Home LLC. We're going to comment a little bit on that and how some of the non-QM products fit into that scenario. When we come back after the break, again, I'm Tony Mendez. That's Gordon Hines. It's the Real Estate Report on AM 1220 KDOW. Welcome to call the show or email 800-516-1220 or Tony or Gordon at BayAreaLoanSource.com. We'll be right back after this break.
Got a question? Run it past these guys. 800-516-1220. It's the Real Estate Report with Tony Mendez and Gordon Hines on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez. Thanks for joining us today. You can always call the show 800-516. Man, that music kind of put me in a really, really kind of mellow mood. But we are really excited about the industry right now. Everyone is. Everyone's talking about real estate. If they're not talking about it, they're thinking about it. One of the reasons why is home prices continue going up. People want to jump on that bandwagon. You know that, George. You've been seeing. George is with Arc Home LLC. He's one of the lenders that we use, or investors, as we would call it, wholesale lender. One of the specialties of George is what they call non-QM, non-qualified mortgages. It's what they call near misses. Fannie Mae and Freddie Mac, FHA, VA, USDA, near misses. If you don't qualify for them, you're going to go to a non-QM loan. And there's a use in it. There's an absolute use. We've used more non-QM loans in the last 2 or 3 years than we did, I think, subprime stuff back in the day, because they're so useful and they're so versatile. We've already talked about the alternative income, bank statements, and asset utilization. But there's other products that are out there called, one of them in particular that I really like is the DSCR. That's called debt service
coverage ratio.
So
it's an investor-based product based on cash flow. So it's an investment property.
What really surprises me about this product, it goes to $2.5 million on 4 units.
Yes.
So you're still in the residential product. You're not going commercial. It's still residential, 1 to 4 units, but up to $2.5 million with as low as a 680 credit score. And what this product does is...
Basically, it's a no-income qualifier, no income, no employment. And it really qualifies based on the rents, on the cash flow of the property. So as an investor, as a lender, we want to make sure that it's going to cash flow. It's going to pay for itself. And that's what we're lending on. So it's a little more aggressive.
It has a higher loan to value, 75%, as opposed to, we've even seen private money, George, that is
50%,
60%, or even 70%. Yeah. This one goes to 75%. You just have to cash flow. And it's a 1-to-1 ratio. So your PITI, which is your principal, interest, tax, and insurance, which is your housing obligation on that property, has to equal rents. Is it 100% of the rents, or?
It's 100% of the rents. Now, we also allow interest only. So we'll qualify in the interest only payment, which will allow you a lot more home as well. Not to mention, we'll take it a step further. We are actually, depending on the loan amount, we'll go to 80% loan to value. Now, we also will allow you to go down to not a 1.0, but a 0.75. So you can
ratio.
Correct. Okay. You have a 0.25% deficit and still qualify for a loan.
So the rate's a little bit higher for something like that, which i.e. also means cost. But you would also consider this as a temporary loan.
Exactly.
It's not a quick fix. It's still a loan you have to get, but you don't get this as your permanent loan unless you are,
Well, I mean, this can work for an investor. Say you have an investor that has 20 properties, 25 properties.
Are there limits on how many mortgages you
have? Well, currently with us, it's 20. So we'll allow up to 20 finance properties. And, but, and I expect to see a change on that as we move forward. But currently, I mean, if you go over 10, you no longer qualify for a qualified mortgage.
Yeah, qualified mortgage. So this has another purpose in it as well.
Exactly.
What about your other non-QM products? Will they also go to 20?
Yes, they all go to 20. So the full doc,
and we've seen really good rates with it. Now they're not your Fannie Mae, Freddie Mac rates, but we've seen really good rates.
Oh, absolutely.
With these, you call them Agency Plus. I'm sure other companies have different names for it.
Correct.
But you can go up to 20 finance properties, or is it 20 owned properties? Because I've seen a lot of lenders now saying it's not just what you finance, it's what you own. Yeah. And a lot of times they're doing this too because they want to give you you've heard about these other lenders that are offering incentives if you're like W-2'd and you own no property. So the simpler the loan,
Sure, absolutely.
for underwriting, they're going to give you, maybe a quarter better in fees or maybe a half in fees, just because it's easier to do.
Absolutely. It's all risk based, and it's price. It's the cost of a loan. So in that situation, you might get a better price just because you're simple.
So we had a client that used one of these. I think you remember down in Santa Barbara, they had a beautiful 2-unit property, and they owned the land next door, and they were going to build. And they did a cash out loan on this, and it worked for them. They used even though they were renting a little bit less, they used the market rents on it.
Correct.
They were over the 1%, so it worked perfectly for them as far as the what do they call it, rate, the service
the
service
debt
ratio.
service ratio. Yes, the cash
So
flow.
they exceeded your expectations on that. They were able to get the cash out to able to fix the land up and build the property right next door. And now they're sitting on a situation where they can use the rents on that property, the other property they built, and the rents on this one. And now they have two properties right next to each other. These are great products. I mean, we continually talk about how these drive the market, but it seems like a lot of these are geared more towards investors than it is towards just your normal single family home, primary residence.
Sure. So the DSCR program, the investor program, it really does cater to the investor. And if you really look at it, it's all about cash flow, right? And it's all about leveraging your equity, leveraging your asset. It's like, okay, you buy a home, you gain some equity, you pull some out, you buy another home, you buy another home, you buy another home. And that's how you build your portfolio. And how do we retire when what's our plan? So the more homes you have, typically, the more cash flow, and you retire on that.
What's your thought on that note? A lot of most people are buying real estate as passive income, right?
Absolutely.
Or is it non-passive or passive income?
Passive income.
So they've built a portfolio over years. They've let other people pay their principal down, and they refinance it eventually or sell it. They consolidate it into a better product or a better property. It's cash flowing. It's giving them a rate of return every month on their investment. Is there a certain age where you just say, I'm going to stop buying property? I mean, you've been doing this years. You've been in how long?
I've been close to 30 years.
30 years in this. You've seen every type of investor.
Absolutely.
Where do they stop? Because I was, I'm 50 plus, and I thought, maybe I don't want to buy any more property because I don't have enough time left to get to the point where it's going to generate, and I just want to just not mess with it. What's your opinion on that?
Tony, there's no limit. I mean, I see all walks of life depending on their backgrounds, their age. It doesn't matter. It really comes down to what their goals are, and if it's not them, it's their family. It's generational. They let they pass it on. So it's they see it as a retirement. They see it as a business. They see it as a ways of life. I mean, being an investor and being a savvy investor, you just have to know how to do it, and these products allow you to, more so than sometimes the qualified mortgage.
I like a lot of these products, Gordon. You've been doing this for many, many years, where private mortgages, or the other hard money, has been the alternative to your standard qualified mortgage, is what we would call it today. But now we have this in-between product. How often are you considering this for your clients and yourself?
Well, I think it's a great program. George mentioned it. It's targeted toward the investors, but it's also targeted to people to acquire real estate. Like he said earlier, you can't get in the traditional way. Now it's a short-term project. You get in the project any way you can, and the market and time is going to take care of the things that you need to do. You can get in, fix something up, rehab it, and then refinance it into a standard conventional loan. So a lot of times it's about strategy, and it's about products, and it's about availability. That's the reason why you own a house and the guy next door doesn't own a house, because he doesn't have access to these products that we're actually selling. And this is the reason why the market is so strong, simply because of these products.
Certainly, when you are an investor, you have to implement a plan. You have to have the pieces that work, the loan, the property, the commitment into it, I think, which is, for me, is the hardest part of any transaction, is making the commitment to get into real estate or expand your portfolio or even shrink it or consolidate it. These are some of the products that are out there to help you use. George, we're going to keep you around for another segment, but you're always welcome to call the show, 800-516-1220, 800-516-1220, or email Tony or Gordon at BayAreaLoanSource.com. This is the Real Estate Report on 1220 KDOW. We'll be right back after this break.
Tony and Gordon are taking your calls at 800-516-1220. It's the Real Estate Report on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
It's been an interesting year, Gordon. 1 year later, I don't think a lot of people thought that real estate was going to be the big hero in the economy. We've seen double-digit returns all across the nation. I mean, places like, I was just looking here, places like Jacksonville, Austin, Charlotte, they're 13% year over year. The housing market, they gained $4 trillion in value in the past year as people have transferred their wealth from major hubs from like San Francisco and New York into these affordable cities. A lot of different, then we had the whole adoption of the work from home mentality that really started pushing people to these areas. Sacramento's on this list. Sacramento's one of the biggest, in the top 10, I believe, in the nation as in increased home prices because of this trend. So, this last year's been phenomenal for places like that. But at the same time, I have a place in Reno, and they've exploded as well. And a lot of people are complaining about the natives, as you want to call it, have complained about the rising home prices, taxes, the crowded bars, not much so right now, but the streets, the traffic, and so big trends have happened in this last year. The fact that we've seen more and more people buy homes sight unseen, is that a trend? We're seeing commissions drop, not much, but we're seeing it drop. We're seeing companies like Redfin, a lot of what they call iBuy companies that are starting to really come out as a major player in certain markets in the United States, where they're sight unseen buying this house using these algorithms. It's been a strange year.
Yeah, I think if you talk to any economist, I couldn't see any economist that would disagree with us that the housing market has been the savior for the economy. If the housing market would have crunched like the stock market did in the second quarter and into the third quarter of 2020, I think we'd probably be in a depression state right now as far as the economy trying to dig itself out. But because the housing market stays strong, because of the options that came about, simply because of the changes that went into place, I think the housing market, kudos, should be touted as a savior of the market, which is keep the stability in the economy and has actually got us thinking now that we can actually get past this thing and with few scars.
60% of buyers are priced out of their own current market. Those are 60% of those people, Gordon, might not agree with you as far as how the housing market has been a hero to them. Their rents went up. Granted, they may not have had to pay their rent, but now they're getting priced out of the market, Gordon. So it's kind of a double-edged sword here.
Well, you can't please everyone all the time. But if you look at the economic side of it, forget being priced out. You want to be priced out, or you want to be in depression in the economy. Depression in the economy is not a good thing. Go look at the calendar, what happened in the late 20s and in the 1930s. So when we look at the overall complexity of the market from a financial standpoint, you look at the stock market, you look at the inflation, you look at jobs, you look at growth, you look at the stimulus plans that the government has put into place to help navigate through this, and the housing market stayed solid and appreciating. That was a great savior towards all the different things and all the different plans that we talk. You think a $1.9 billion stimulus plan is a lot now. Think if the housing market would have crashed, we're probably looking at a $10 billion stimulus plan just to keep the economy going.
There's definitely been a better reaction from the Fed this time with the forbearance. I actually liked the program. Some people took advantage of it. Then you had the PPP, you had the stimulus products. George Ramirez with Arc Home LLC is one of our investors that we use. What is your thought? I mean, you saw some major changes. You've had a couple changes over the last year personally as well.
Sure.
This has impacted you and the industry that you work in.
Yeah, COVID definitely changed lending. It came to a standstill when it came to the non-QM, the non-qualified market. So there's a lot of changes, a lot of looking at the market and what's it going to do, a lot of unknown. So me personally, a lot of changes in 2020. But, we've emerged and we've come back stronger than ever, giving, buyers the ability to get in homes and having more options. So, I think that we're in a better place today, actually, than we were pre-COVID.
Than we thought we were going to be as well.
Exactly.
Yeah.
So, we do have some great opportunities for, borrowers to get into homes.
I agree with that in most parts, even though we look at charts all the time and,
Sure.
Mortgage accessibility is back to what it was like in 2014. Remember 2014? It was hard to get a loan. At least it felt like it.
Yeah.
Now we have few inventory that's causing home prices to go up. We have 60% of people who say they're getting priced out of the market. These are real statistics. And yet we feel really good about the housing market. What does that say about our, the haves and the have-nots? That's a tough dilemma right there. That's a really tough social dilemma because a lot of people are still feeling like they're being left behind. We need a correction. Then there's the people who are just sitting on the sideline. Gordon, you've been talking to those people for how many years? Many years. And, these products are here. Gordon, you guys, I'm sorry, George, you have some great products. Non-QM Market is great. You've been an expert at it for years. What we'd like to encourage anybody to do is just shoot us an email if you want to learn any more about these products. We have what they call the asset utilization product. Sure. We have the alternative income bank statement product, the DSCR, the investor product. Mm-hmm. These are products that are there, and there's even more that are out there. George, thank you very much for being with us today. We'll have you back again anytime. Again, you can shoot us an email, Tony or Gordon at BayAreaLoanSource.com. That's Tony or Gordon at BayAreaLoanSource.com. Any last words, Gordon?
Well, the music means that we'll have to tune in next week to find out what's happening.
1 year later, guys.
Absolutely.
COVID. 1 year later, and we're still hanging in there. We'll come back next week. Thanks for joining us. I'm Tony Mendez.
And I'm
Gordon Hines. You can always reach us at BayAreaLoanSource.com. That's BayAreaLoanSource.com. We'll be back next week here on AM 1220. Same time,
same station.
Thanks for joining us.